Hi, my name is Dr. Annette Moultrie, and this is Accounting 101. So, let's see what we will teach in this video. But before we proceed with the video, I need you to click on the subscribe button. Click on the thumbs up button below. Click on the notification bell so you'll be notified of upcoming videos. Also, please share this video. Here we are at the end of Chapter 3, the adjusting process. This is part 4. So the learning objective is 3.4, where we explain the purpose and prepare an adjusted trial balance. The adjusted trial balance includes all of the adjusting journal entries associated with deferred expenses, deferred revenues, accrued expenses, and accrued revenues. Now, the purpose of the adjusted trial balance is to ensure the debits and credits are equal. Even if the debits are equal to the credits, there could still be potential errors in the journaling or posting processes. The adjusted trial balance is used to create the financial statements prior to the closing process. The debits are equal to the credits in the adjusted trial balance, which is similar to the unadjusted trial balance that we discussed in Chapter 2. The information from the adjusted trial balance is used to create the financial statements in the following order: income statement, statement of owner's equity, and the balance sheet. The adjusted trial balance for Smart Touch Learning is what you see here in Exhibit 3-5. This is the adjusted trial balance for Smart Touch Learning. So again, financial statements are prepared from the adjusted trial balance. Okay, this is the last objective. Objective 3.5, identify the impact of adjusting entries on financial statements. Failure to record the adjusting entries result in inaccurate financial statements. For example, if the adjustment for a deferred expense is not made, the asset account will be overstated and the expense account will be understated. Now, this type of error results in an overstatement of net income because the expenses are too low. A summary of the impact on the financial statement is shown on the next slide, which is Exhibit F3-6. Here you see Exhibit F3-6, impact of adjusting entries on financial statements. The adjusting journal entries are absolutely necessary to the financial accounting and reporting process. Without them, many accounts will be understated and others will be overstated. For example, if we fail to record accrued revenues, both the assets and the revenues, and subsequently the net income, will be understated. Or if we fail to record depreciation expense during the period, assets will be overstated, while expenses will be understated, just too low. thereby resulting in an overstatement of net income. So here at Exhibit 3.6, you have the type of adjusting entries. You have deferred expenses, deferred revenues, accrued expenses, accrued revenues. So we know that deferred expenses, advanced cash payments of future expenses. The adjusting entry is an expense asset. There's a debit or credit, and the impact on the financial statement if adjusting entries are not made. On the income statement, expenses could be understated and net income overstated. On the balance sheet, the assets can be overstated and equity overstated. I'll let you take an opportunity to review this chart here so you can see for yourself how it will impact financial statements if the adjusting entries are incorrect. Learning Objective 3.6, explain the purpose of a worksheet and use it to prepare adjusting entries and the adjusted trial balance. I may have said that the previous objective was the last, but my mistake. There are more. I think there's one more. So we're discussing Learning Objective 3.6. So how could a worksheet help in preparing adjusting entries and the adjusted trial balance? Well, a worksheet is a useful tool to aid in preparing the adjusted trial balance. The worksheet provides columns for the unadjusted trial balance, the adjusting entries, and the adjusted trial balance. The worksheet is an internal document, and it is often prepared in Microsoft Excel. So the worksheet has 4 sections: account names, unadjusted trial balance, adjustments, and adjusted trial balance. In the next slide, you'll see a partially completed worksheet. Here you see an example of a partially completed worksheet. Now, this worksheet will be completed in Chapter 4. However, in this chapter, we complete a part of the worksheet. For now, we will concern ourselves with the first 4 sections. Section 1 is the account names. The account names are taken from and listed in the same order as the chart of accounts. You have your cash first, accounts receivable second, and so on and so forth. Section 2 is the unadjusted trial balance. This is the unadjusted trial balance. The account balances are copied directly from the ledger before any adjustments. Total debits must equal total credits. Section 3 is the adjustment. Now, enter the adjusting journal entries that were made on December 31st. Here in Section 4, you have the adjusted trial balance, the adjusted trial balance. Now, this gives the account balances after adjustments. Each amount in these columns is computed by combining the unadjusted trial balance amounts plus or minus the adjustments. Note that the worksheet does not eliminate the need for recording the adjusting entries in the journal or posting them to the ledger. The worksheet is simply a tool. It is simply a tool to assist in evaluating the accounts and determining which accounts need adjustment. Learning Objective 3.7. Understand the alternative treatment of recording deferred expenses and deferred revenues. So we will understand the question, what is an alternative treatment of recording deferred expenses and deferred revenues? Now recall that deferred expenses, also called prepaid expenses, they are advance payments of future expenses such as insurance, rent, and advertising. Office supplies are also accounted for as deferred expenses. The journal entry on this slide that you see here illustrates an example of debiting an asset, which is prepaid rent, when rent is paid in advance. So here you see this example. Smart Touch Learning prepaid 3 months of office rent totaling $3,000 on December 1st, 2024. So there's a debit of $3,000 to prepaid rent, and cash is credited for $3,000 paid rent in advance. Deferring an expense creates an asset. However, the asset may be so short-lived that it will expire in the current accounting period within 1 year or less. Thus, the accountant may decide to debit the prepayment to an expense account at the time of payment. The entry could alternatively be recorded as a debit to rent expense and a credit to cash. As of December 31st, only 1 month's prepayment has expired, leaving 2 months of rent still prepaid. In this case, the accountant must transfer 2/3 of the original prepayment of $3,000 or $2,000 to the asset account prepaid rent with an adjusting entry. The adjusting entry here is a debit to prepaid rent and a credit to rent expense for $2,000. At the end of December 31st, the $3,000 prepayment is correctly divided as $2,000 of prepaid rent and $1,000 of rent expense, regardless of whether the business initially debits a prepayment to an asset or to an expense account. Another way to account for the receipt of cash is to credit a revenue account when the business receives cash. This is another way to record or account for receipt of cash. There's a debit to cash and a credit to service revenue. Now, if the business then earns all the revenue within the same accounting period, no adjusting entry is needed. However, if the business earns only part of the revenue in that period, it must make an adjusting entry. Here in this example, Smart Touch Learning has earned only 1/3 of the $600, okay? Smart Touch Learning has earned only 1/3 of the $600 by December 31st. Accordingly, Smart Touch Learning must make an adjusting entry to transfer the unearned portion, which is that 2/3 of the $600, from the revenue account to a liability. So in this case here, $400 is debited to service revenue and $400 is credited to unearned revenue. And the explanation is to record unearned revenue. The adjusting entry transfers the unearned portion of service revenue to the liability account because Smart Touch Learning still owes e-learning services next year. After posting, the total amount, $600, is properly divided between the liability account, $400, and the revenue account, $200. So at December 31st, the $600 cash received is correctly divided. You have the $400 of unearned revenue and a $200 of service revenue, regardless of whether the business initially credits the cash received to a liability or a revenue to a revenue account. Okay, so this is the end of chapter 3. So in chapter 3, we discuss and differentiate the difference between cash basis accounting versus accrual basis accounting. We discuss time period concept, revenue recognition, and matching principle. We also explain the purpose of and journalize and post adjusting entries, explain the purpose of and prepare and adjust the trial balance. We also identify the impact of adjusting entries on the financial statements, explain the purpose of a worksheet, and use it to prepare adjusting entries in the adjusted trial balance. And lastly, we discuss the alternative treatments of recording deferred expenses and deferred revenues. Again, thank you, and please look out for chapter 4. Chapter 4. Thank you for watching. And please, if you haven't already, please click the subscribe button below.